$1,000, we debit 1,000. I put it in restricted. Typically that goes into an escrow account. That'll go with a, with a broker. It'll go with an attorney. You typically, yeah. Listen, if you're an intelligent buyer, you're not going to put a deposit with a seller. Okay, you're going to put it with some sort of third party. Okay, and again, so there's some prepayment of commissions here. Okay, it wasn't asked in the question, but you needed to do it to get the flow right. What is different is, so investment sales. Investment sales in this country are not, so leasing commissions we typically know are 6%, right? Or,
yeah. 3 and 3.
Well, no, it's not 3 and 3. So leasing commissions tend to be 6 to 7%. So I'm talking commercial now, 6 to 7%. And that typically depends. You typically get 2 to the listing broker, and the tenant rep typically gets 4. So if you're in bad times, or you get a landlord that really wants to take care of their broker, he'll give the listing guy 3. So you might pay 7 altogether. Residential sales transactions are typically 6%. I think you're starting to see some pushback on that as values in Florida have moved up. In high-rise multifamily sales, I've seen a fair amount of prepayments of commissions to brokers. That was very prevalent in the mid-2000s, and a lot of developers were out money on deals that never closed.
Yeah.
But it's what the market demanded. And so, as much as 2/3 of the commission was being paid up front. Typically in residential transactions, you don't see that. Okay? And then in investment sales, in a simple case like this, commissions are typically not 6%. So investment sales commissions are negotiated. But you guys have done the investment due diligence class. What are typical investment sale commissions in this country? What's a good round number to start with? 1%. 1%. And typically you don't have someone representing the buyer. So it's typically a seller issue only, and the seller's agent is the one who would typically get all that commission. Okay? So it's a little nuance. It's not all indicated in this particular case, but just I'll mention this over and over again in other classes as we go forward. We go to question number 8. Okay, so now we close on the land. We got the deposit, now we close on the land. Okay, so bunch of journal entries. Okay, bunch of journal entries that need to get done. Okay, I'm not going to go into huge detail in all of them. Okay, but we receive the balance of the cash, we record sales. Debit 4,000 cash, credit sales. Let me jump ahead for a second here. I had restricted cash, which is now going to come to me, right? Because I'm going to get the whole 5,000. So I get the 1,000 out of escrow and put it to cash. A lot of you forgot that there was a cost of goods sold. So there's land I need to get out of my balance sheet. So I need to record my cost of sales. So I need to credit my inventory, credit my balance sheet, and debit my income statement. Remember, the P&L, sales, what gets deducted from sales? Cost of sales, or cost of goods sold, right? So whether you're building for inventory or you're selling an asset, there is a cost that needs to be recognized, okay? And in the case of a development business, that likely, in the case of most businesses, that's likely coming from the balance sheet. So we need to get rid of the land on the balance sheet and recognize the costs on the P&L, okay? We got to get rid of the sales deposit. Okay, we did that. We got to recognize the balance of the commission. We had a prepayment. We made an advance on the commission, right? And we got to finish paying the 125 so that we pay them the 6% commission that was agreed to. Okay? Now, I went ahead and jumped the gun now. Okay? I jumped the gun for a second, and I just went ahead and said, hey, this was an SPV. What's an SPV? A special purpose vehicle, right? Or a special purpose entity, an SPE, right? So we sold the only asset it had. We're going to get rid of it. The organizational costs, we don't need those anymore. So we get rid of those, okay? Now, I'm gonna jump for a second to the P&L, okay? So, sales, 5,000. We all know that, right? Now, this was a simple enough case. You probably could have built this without doing T accounts and journal entries and all that, okay? But cost of sales, 1,200, 3,800, SG&A, 425. That was Bahia. I'm sorry, that was the brokerage commission plus the traveling expenses, okay? And then, so remember, I said I created this particular company to not be, or entity to not be tax efficient. So I accounted for income taxes. Now, if we're smart, we're going to structure our real estate businesses in a tax efficient environment. We wouldn't have income taxes to pay, okay? But I just did that in my suggested answers to just demonstrate or to make you think or always think that in business somewhere, whether it's at the shareholder level, whether it's at the member level, whether it's at the partner level or at the entity level, we can't forget that Uncle Sam's going to ask for his share. Okay? So that's the P&L. I just assumed 38.5%. Now, the last question was, how much does everybody get, right? How much do we distribute? So, I did this running balance sheet, right? Just to sort of justify. And ultimately, so I just sort of posted on my balance sheet all the ins and outs, and ultimately came back to the fact that I had, after accounting for income taxes, because remember I paid taxes, I came up with $4,085 that were left, right? And how do I sort of proof it? I had $2,035 profit. Sorry, $2,085 profit, and I put in $2,000 of original equity, right? Right? So it's $4,085. Each guy gets half of that, right? $2,042.63. Okay? Now, what's important? So to get the right answer on this one? No. Do I expect you to be accountants? No. Should you have gotten close? Those of you who have a financial background should have. But what's important is that all the concepts that we just talked about that ultimately support the discussion that we had about the accrual basis of accounting is what sticks in your mind. Income is recognized when it is earned. Expenses are recognized when they are incurred, not when cash is changed. Regardless of whether I pay or I'm paid, what matters is when the service is rendered, when title is transferred, when risk of loss is transferred as well. There'll be nuances in this industry. There'll be nuances to revenue recognition. We'll deal with that in week 3. There are nuances as it relates to certain costs. We'll deal with that in week 3 as it relates to selling costs, and week 4 as it relates to development costs, okay? But generically, conceptually, the thing to always keep in mind is income and expenses are earned and recognized, are recognized when they're incurred or earned, okay?
Can there be a circumstance where you do engage someone to, say, create a plan for you, and they go ahead and they have delivered that plan, but have yet to kind of give you an idea of what their cost was?
Well, so it could happen. There are creative businesses out there. It could be architects. They do all this work and they forget to bill or whatever. Yeah, but you have an, again, who are you trying to kid? You should always have an obligation. First of all, if it's a significant sum, people are going to bill you. Okay? And you're not going to engage somebody of any substance or significance without having some sort of agreement in advance. Okay? Now, you know, you can have an hourly thing and not know, but you have an obligation when you close your financial statements after every period to make an estimate of what your liabilities are at a particular date or the expenses you incurred. In fact, you know, one of the audit techniques that are used is what's called a search for unrecorded liabilities. And how does an auditor do a search for unrecorded liabilities? He looks at disbursements subsequent to a balance sheet date. So you close the year 12/31, you know, your auditor gets here in March, and he says, okay, give me your cash disbursements records from January through March, and see who you paid after the year, and then you see whether any of those payments related to items, you know, from the prior period. And while that's an audit technique, in business, I've always used that. So I don't keep books open for 3 months, but we typically would close books depending on the business. Some businesses we're able to close books on the 10th of the month. Some businesses we issued purchase orders. So we knew what purchase orders we had open and didn't have accounts payables that had come in. So we knew what liabilities we may have, okay? In some businesses, because we didn't have that good a record, I'd keep books open till the 15th or the 20th to see what invoices came in after the fact. Okay, but you have an obligation, again, because you don't want to kid yourself, to record all obligations that you have, whether or not you received an invoice or not. Okay? Questions on the case?
So, but like for, I know it's not tax class, but for like tax purposes,
Yep.
you can do, you know, like prepaid rent, and you can deduct that in the year that you pay, right? Versus,
Well, I'm going to give you the same answer that I get from TurboTax. You should check with your tax consultant on that. I am not going to tell you that if you pay rent for January and December, and you record it in December, and your tax preparer doesn't know that it's a January rent, and you're on an accrual basis of it. See, you can report for tax purposes on a cash basis. So if you're a cash basis reporter, right, and you paid it in December, you can deduct it.
right?
You can deduct it, right? But if you're an accrual basis preparer or reporter, you know, that's a prepaid. Now, can you get away with it? I mean, I read to you earlier, there were 4,000 IRS criminal investigations done last year in this country. That's criminal investigations. I don't know how many audits were done, but how many tax returns are audited? 2-3%, very small amount. But I go back to, listen, I'm going to be altruistic here, and the reason this country works, and I've traveled all over the world, the reason this country works is because people pay taxes. I spent a lot of time in Brazil, and the saying in Brazil was, people pretend to pay taxes, and the government pretends to provide services. So ultimately, but that's why things are the way they are. So the reason things more or less work in this country and they don't in a lot of other ones is because there's a modicum of adherence to the law, including tax law. So, I was just guessing. I knew you took the wife and the kids to eat and you ran it through the company. I was just guessing. I didn't mean to call you out. No, listen. A lot of people do that stuff, okay? But I go back
We
to.
talk about business at dinner, though.
I'm sorry?
We talk about business at dinner.
But you're talking about me.
I don't want to get it. No, look, you're asking me, and here's what I can tell you. I know people that are very aggressive in their tax compliance, right? So, and you can be aggressive in 2 ways. You can be aggressive in areas where you can interpret the law and you have the footing to interpret the law in a particular way, or you could just gamble. Because ultimately, if you are not adhering to the law and don't have a basis for adhering to the law, you're playing a game of chance that you won't get caught. And, the statistics would support you. I had a friend someone I've invited to this class to speak, and he was telling me the way he structures his wife's salary. His wife works for his mom, and I said, look, dude, I hope you sleep well at night. He said, no, because I can deduct this. And I go, dude, I wouldn't do what he does. No, my accountant said, great, your accountant signed your tax return, and he's got his business on the line. I'm telling you this, and I don't want to sound like I'm holier than anybody else. I sleep really, really well at night as it relates to my taxes. And if I make an error, it's because I made an error. It's not because I was aggressive. I've been more aggressive with corporate decisions, but I've always made the shareholders aware. We took a stance when we acquired a business, this was before I got into real estate, where we allocated a purchase price a particular way. And I told the owner, Joe, this is the risk. If we get audited, this is what I'm doing. He said, do it. So about 5 years later, I get a call from the guy that was a CFO there. I'd left, and, you know, why the hell did you do this? Listen, go talk to the owner and talk to him about the conversation that we had. You know, so we took an aggressive stance. We knew there was risk, and if we got audited, there was a high probability that it was going to be looked at a different way. But I made the owner aware. Ultimately, he made a decision. So, you know, I'm not telling you that most people aren't, you know, pretty aggressive. And again, the smaller the business, the more there is a commingling of the personal entity and a corporate entity. Okay? There are also ways that you can, you know, sort of make it look like, so yeah, I was talking, you know, you take your family to dinner and you know, you write a client's name on the slip, right? You can make it look very, you can create the audit trail that you would never be caught, right? And so, I'm not telling you to do one thing or another. I would just tell you, if you sleep well, this guy Joe had a partner in the business. And I remember we went on a dive trip. We took a whole bunch of people from the company on a dive trip to the Keys, and we're sitting at the fish house, and I'm sitting across from the partner, and the partner's telling me, no, Joe, he goes, I got to go talk to the parish priest because, you know, I wrote off like $15,000 worth of contributions to the church for the last 5 years. I'm like, and Gene, didn't you make these contributions? No, he didn't go to church. So, you know, he was putting himself in a position where he had to go ask a guy to lie for him and come up with a letter saying, you know, because when you contribute to a 501c3, they have the obligation to give you written evidence of the contributions that you've made. You know, now, what I did is, that friend of mine that I said had been a partner at EY, I had him sit in a table behind, and he started saying, really in a loud voice to another guy, yeah, a friend of mine just got, you know, caught cheating, you know, he's making phony charitable contributions, and the guy's going to jail. You know, that guy wound up in the hospital that day. You know, he started getting palpitations, but, you know, it's an issue of, if everybody does the right thing, taxes would be lower, services would be better, and we'd all sleep great, and, you know, we'd all go to heaven. But, you know, and I'm serious, speak with your consultant, or your advisor. Most people are more aggressive than I am in those areas, and that's one of the reasons I don't practice, I don't do any tax work, I won't do anybody else's tax return, and I don't want to really ever get into that business. Yeah, Alyssa, you had a question? Oh. Maricela.
Yeah, on the book, you're talking about direct cost and stuff like that, directly identifiable and 3
Yeah, we'll get into detail on that when we, in the 4th class, when we talk about development costs, when we go over FASB 67, we will get into project costs and directly identifiable and indirect costs.
Because that's pretty much...
Yeah, but we got 4 more sessions. We got 4 more sessions.
Can you, sorry to beat a dead horse, can you repeat the income and expenses recognized when they occur? When is revenue recognized?
No.
Income is recognized.
Income is recognized when it's earned. Expenses are recognized when they are incurred. Now, there's 2 sides to every transaction there, right? So, you know, there's like a yin and yang. Right? So there's no accounting god that if you record income, somebody's got to record an expense, but if everybody's following the same norm, when you record income, somebody should be recording expenses, and when you're recording expenses, somebody should be recording income. Now, I went just to show you, I did P accounts for all of the different accounts, and I put the different journal entries. just so that you would see how you would, you would do that, right? Okay? So that's it. Okay?
Will we be able to keep that copy, just have to study off of it?
No, for two reasons. One, because I don't give out answer keys. And just, mysterious things happen with answer keys.
They get on
So
websites.
you stay afterwards, I'll explain it to you, but answer keys, disappear. And people then bypass the learning process, which is why we're here. The second thing is what I gave you was a very general, top-level overview of how to deal with some of these accounting issues. The reality is each one of these we're going to delve into in specifics as it relates to real estate in each of the next few sessions. And so I'd rather go over development costs or revenue recognition directly related to real estate on 66, 67, or how to deal with lease costs or lease recognition, revenue recognition, when we deal with that specific subject in the class. Okay? So I feel like I've been through like 8 rounds in a boxing match,
So you're winning. Just put it down.
I don't think I'm winning.
You got it, man. TKO.
On the ropes.
Okay, listen, just a couple of tidbits. Hey, just a couple of tidbits.
I'm sorry.
Would you like to share?
No, we're discussing about again on the verbiage of Bardeco engaged Ronaldo Santos to perform the.
We're stuck on.
No.
Okay, remember, the issue here is the broad, the objective is the broad learning concept of, forget whether I phrased it as emphatically or as I should, and it's what I was telling Dustin before, it's not an issue of whether, there's nothing in accounting that is absolutely right or wrong, okay? But it's an issue of utilizing this body of knowledge called GAAP to account for things in a way that a prudent reader of financial statements would not be misled, or better yet, would be led to fully understanding the nature of the transactions or the results of operations based on the facts that happened. So if you read it differently than I did or than you did, that's okay, as long as you go back to, okay.
It's accrued liability.
Yeah, and but ultimately, why does it matter if it's a liability on this date or not? Is because on a particular date, a reader of the financial statements should be given the opportunity to truly understand the nature of all the transactions that have transpired. If accounting purports to be the history, the financial history of the company, it should reflect at any given point in time what its true financial position is and what its results of operations have been for a period. So, if our accounting takes us there, then we've done the right thing. And listen, I'll show you next week when we go over leases, there are companies, big companies, that account for significant lease transactions in a way that I think is not in the spirit of what the accounting literature requires. Is that right? No. But can you at least get the information you need from the footnotes? Yes. Okay. I'm going to spend a few minutes. I'll do this again in another class, but I want to just give you a little synopsis of how a real estate company might actually be organized, okay? So, Saunders is going to be a billionaire, right?
Yeah.
Yes, sir.
Saunders Co. is a real estate development business, okay? And since he wants to have a lot of airplanes, he needs to have a lot of airports, right? So he needs to create a lot of SPVs, right? Special purpose
vehicles.
So I'm just going to show you what some people do, okay? I'm not telling you that everybody does this, I'm not telling you this is across the board, but this is a hypothetical structure, okay? So Saunders has a development, he wants to build, he buys this parking lot here, and he wants to put a building up. So he's gonna create an entity, okay, that is gonna own that thing. So it's gonna be called BCC Land Co. BCC Land Co. Okay, just for argument's sake. Now, is Saunders' company gonna own this?
Yes.
Yeah.
Maybe, maybe not.
I have an interest.
Okay, so let's kind of go back and say, what kind of entity, what kind of legal entity are you going to create? Do you want tax efficiency or not?
I want to be very tax efficient.
Okay, so if you want to be tax efficient, you might create a partnership here, right? You might create what else? Let me get to the REIT. I don't think you want to do a REIT, and I'll tell you why in a second, but so maybe an LLC. So we don't really see partnerships that much anymore. We see a lot of LLCs, right? Because they've got the same sort of level of legal protection, but the same tax treatment essentially. They're disregarded or passed through entities, right? Now, there's a whole bunch of other sort of, you know, you could do LLPs, you could do LLPs, you could do MLPs. I'm not an attorney. You could do all kinds of entities. What I see more, and Fred, I don't know what you've seen more, what I see more than anything now is you see people creating LLCs across the board.
Yeah.
Across the board. Okay? You could create any of these tax advantage vehicles. You could create a subchapter S. But again, there's limitations. A subchapter S is so as opposed to a C Corp, right? A regular C Corp, right, which fully pays tax, a subchapter S is like any one of these pass-through entities, right? But there's limitations on it. The reason you wouldn't do a REIT, I'll get to you, Frederick, is that the reason you wouldn't do a REIT is, let's go back to the requirements that the REIT has on the generation of passive income, and if you're a development business, okay, then what's going to happen is you are not going to be able to meet the requirements for being a REIT, okay? So you may have a REIT as part of your organization. Now, you asked a question earlier about styles, and I didn't forget that, but I'm going to get to that in a second. So Saunders Co. may be an LLC, okay? So the likelihood would be that I may want to create an LLC here, right? Do I want to create an LLC here? Maybe. Let's create an LLC now. Let's create an LLC. Now, is it going to be a single member, or is it going to be a very, you know, multiple members? Single member? Why don't we have 2 members? No, because I can create LLCs, right? So I might want to do something like this, right? Here, I'm going to give you a better, let's just do this. I'm going to do a limited partnership here just to show you something else. I want to do a limited partnership, okay? So what am I going to do here, right? I'm going to create an entity here that's going to be the general partner that owns 1% of this, right? And then I'm going to own 99% of that here as a limited partner. What have I just done?
Create a layer of protection.
What have I done with the liabilities from this entity? I pushed them to the general partner here, which is owned by who? Maybe the son of the owner.
In Delaware.
In Venezuela. Right? So now I've created an environment where I can shield whatever risk may be happening here from the rest of the organization. Okay? Now, I'm going to give you what is potentially a more likely scenario in a real estate development business. I'll get to you, Justin, in a second. I'm going to purport to you that most local developers don't even have this. So everybody's going to say, hey, Saunders Co. is developing BCC, you know, parking lot company. Robert Saunders personally, and through his children and his wives and mistresses, actually owns the 99% of the equity interest in that business. And he's got a son, you can say, well, how does this company survive? I'll get to that in a second. I'll get to, you're talking about the different layers and styles. I don't know exactly how styles works, but I'm gonna guess that styles works a little bit like this in a second. So what's gonna happen is Saunders Co. is an operating company, right? It's a REOC, real estate operating company, okay? And it appears to the world that he owns this development, but the reality is, he doesn't. He does personally, right? He does personally, or through some other vehicles. You know, you're a billionaire, right? So, Bermuda, the Channel Islands, you know, whatever. So through some entity or trust or whatever, you own that. And now you buy another piece of land and you replicate the same sort of structure. You have the same general partner and you've got another 99%, you know, interest that are, you know, coming to this guy. Okay? And so what's happening is now you're channeling the profit there to that person out. Okay, so you say, so what is Saunders Co. comprised of? Well, he's probably got a construction company. He might have a fee service development business. He may have a property management business. He may have a brokerage business. He may have some sort of financial syndication or financial, you know, raising group. He may have a consulting group that does land planning and things like that, right? But none of those entities necessarily participate in the equity interests or the profits of the development. I'm just telling you how most developers work in this town, okay? Now, obviously you could have it all go to the company. Now you can say, well, so what does this company live off of? It lives off of fees that it generates for providing services to all the developments that are being undertaken by the developer. Oh, well, but I got managers here that see this that's going on. They want to make some of the money. What do most developers do here? They let the key managers participate in the equity. So maybe the CFO and the head of the development business and maybe the head of the property management business, you know, maybe they own 5% and he's got 94% or something like that.
Interest participation.
So everyone, and some developers will give those interests. Most developers allow you to go in pari passu, dollar for dollar. Guy puts $1, you know, you get $1. Now, this gets more complicated because, well, to develop this, I got to guarantee a bank loan. I don't want to guarantee a bank loan. So what do I do? What do I do? Find a partner, right? So, and we'll do that another day. I'll pull a partner in, and what I'll do is I'll bring in J.P. Morgan, or teachers, or Pru, or MetLife, or somebody, or Northwestern, and get them to participate, okay? So we'll create another entity, and we might create an intermediary entity to pledge our equity interests to that partner, and that partner will not only then bring the capital to the entity, but will also provide the financial guarantees to the lender. In order to, so what's the purpose of all of this? Why are we doing all of this? Why are we going through all these gyrations? Protection. We want to reduce tax and limit exposure and create an operating company that has limited risk, right? And ultimately create an environment that generates the wealth for the developer. Sorry? Pile of money? Okay. Does that make sense?
Yeah.
Make sense? Yes, Frederick.
I had a question. So, could Saunders Co. be a trust? Would that change the situation?
Could it be a trust? You know, again, listen, trusts are areas of law that are highly specialized. And I'm not one of those people that are experts in it. I would tell you that Saunders Co., I've never seen a Saunders Co., a development business, be a trust. Could it be a trust? I don't know the answer to that. I don't know if there are limitations on activities that trusts can hold or perform. I would tell you that what I have seen quite a bit of is the interests that Saunders has in these entities, a lot of times are trusts. Trusts on behalf of children, trusts on behalf of wives, trusts on behalf of other relatives. So passive shareholdings definitely are structured through trusts. I've never seen a real estate operating company be a trust, and I'm not sure that there'd be any benefit to it. Chad?
Who's paying the taxes at the end of the day? Is it the BCC land company, or is it
Well, no, those, so
Saunders himself?
they've all been created as tax efficient or what are
Right.
called disregarded entities. So the proportional share of the income and expenses incurred by these entities is pushed down through an instrument called a K1 to the shareholder. And he will report his pro rata share, 99 or 94 or 1% of the income and the expenses of that particular entity. So he'll report that on his 1040.
Oh, so he's still paying taxes?
But he's only paying tax once.
Oh, gotcha.
And that's
It's not that the
personal.
company pays tax and then he pays a tax on the dividend.
Right. It's just his personal tax.
It's just his personal tax.
Okay.
So you eliminate the double taxation.
But that K1, that's subject to self-employment taxes?
Okay, so no, the answer is no.
'Cause I mean,
The answer is no.
It's coming as
No,
taxes.
Well, I mean, it could be passive or not, right? So listen, in most cases, most K1s, especially in real estate, I'll give you the examples. I told you, I've invested in 3 different funds. I get a K1 from each one of the funds. For me, it's passive income. Why? Because I don't actively participate in the management of those investments. If I worked for the management company and actively participated in the investment of that, it wouldn't be passive income for me. But it's not a salary. It's not a salary. It is my pro rata share of the income and expenses, right? So, you got interest income, it goes on your Schedule B. You got, capital gains, it goes on your Schedule, whatever, 89, 81, or whatever the, capital gains, Schedule D. The 89, 81 is a detail, but it goes on your Schedule D, right? So,
Yeah, but Saunders Co. is a pass-through entity.
right.
I mean, he's gonna get.
Well, no, okay, so the issue you're talking about, dude, I can tell that you run it. I think you should have gone to the masters in tax. You should have gone to a masters in taxation. I think the issue that you're getting to is so the IRS is going to look at Saunders and say, if you're an employee of Saunders Co.
Right, but you're getting a W-2 there.
Saunders.
It's a rough crowd.
So like your salary there, you get, but the profit from
Right.
Sanders.
From all the investments, Saunders.
You're passing that through to a K1,
Yeah, but that,
including the capital gains that you would make on that.
yeah, but, so, salaries are subject to payroll taxes.
Right.
But salaries is compensation for services rendered, which is different than income and expenses earned in the trade or business. Yeah, no?
No,
Okay. Okay. You own stock in AutoNation.
right,
You get a dividend. Is that salary?
no,
Do you pay self-employment tax on it? No. Okay, well, your K1 is the same thing.
right.
So it is the distribution from a disregarded entity. So that's a C Corp.
Okay.
That pays its taxes. It sends you a dividend. After what's left over, it sends you a dividend. You report back on your Schedule B, right?
Right.
You've got your interest and dividends there, right? Your K1 comes, right? you have, as I said, you've got interest income. It goes on your Schedule B. You have property taxes. I mean, I'm just throwing. It goes on your Schedule A. So the pro rata share, basically, you seen a K1?
Yeah.
All those items just plug into whatever and add to wherever the nature of that item would be in your personal tax return. But the fact that it's coming from an investment vehicle does not mean that it's income or subject to payroll taxes or self-employment taxes, which would be taxes that you owe the government, payroll taxes that you owe the government for services that you've rendered.
I was just looking at your example up there though, and you were using Saunders as.
Well,
a pass-
okay, so what happens
as a
is,
pass-through.
right, so,
So like
okay,
excess operating income, or your net operating.
okay, but the one question that you could ask, which I think would get to the grain of the concern is, the question is, does the IRS look at all that you take home as salary, or are you taking some of your compensation in a form that is not described as salary, but it really is? Okay? And in this particular example, I don't think that there's any concern, okay? There are examples in which, you know, especially more in a C Corp environment, right, where the IRS could come in and say, wait a minute, you're not paying yourself enough salary, or you're paying yourself too much salary, and you're playing with the different tax rates at the corporate or the individual level, right? You know, but, you know, the IRS could come in, but in this scenario, as long as you're paid a salary, they're not gonna have an issue.
I have to admit, that's quite a fascinating case study on my growth of wealth. I appreciate it.
Okay, listen, next week, you're gonna get a case study. You're gonna get two things.
What did you say, in order to minimize the risk when you go and ask, when you go to the bank for a loan, partner up with somebody bigger?
Right, so then you create, so now this entity's sitting here, and now you're gonna own, just to say something, you're gonna own 50% of it, and you're gonna bring another partner, an institutional guy. Here, I've got a better one. You're gonna own 10%, you're gonna bring a guy that, I'll go through a whole sort of promoted interest. I thought I did that in a capital markets class, but I'll definitely do this again, okay? So now, you know, this is the entity, the SPV, that's going to develop something. Saunders Co., right, or its interests are going to own 10% of this, and MetLife is going to own 90%, right? So in a scenario like this, you know, a bank loan is going to come in and fund 70% of the development costs, right? Likely, their sponsorship, their guarantee, or their balance sheet is going to alleviate you from having to personally guarantee or corporately guarantee this loan for the development. Did I answer your question?
Yeah.
Whereas if, so now let's take this partner out. Now you're a local developer, and you know, you own 99% of a project, and some entity that you indirectly control owns the other 1%, right? And you're going to ask for 70% debt on a development project, and you're going to go to a community bank. So you're going to build a 80-unit multifamily complex in Brickell, and you need $10 million from Ocean Bank, and you own 99% of the deal. What kind of enhancement do you think they want from that? Other than your personal guarantee and your firstborn, what do you think they want? You're not going to get around it. You're not going to get around it, especially in a development deal. You won't get around being at risk. And the only way to get around that risk is to bring somebody in. You need different sponsorship. And again, either because of their participation, and getting around it might be a takeout from somebody like that after development. but you still got the construction risk. So maybe a GMP from a guaranteed maximum price contract, we'll go through that. From a GC with a payment and performance bond and a takeout, I still think you got to put a guarantee, but you know, you kind of mitigated the bank's risk at that point. Okay, you're going to have two things to work on for the next class, by the next class. You'll get an invitation in the next day or two to do an assessment at the Wall Street Journal site. It's just a few minutes, and if you read every day, Robert, it'll be really simple. The second one is that the case study for next week is a review of a home builder financial statement. Now, we don't spend a lot of time, I think, Fred, correct me if I'm wrong, I don't think we spend a lot of time here going over home builders or home building activities.
That is correct.
But home builders are developers. They're sort of fully integrated, you know, everything under one roof, you know. They do everything in-house. Most developers do, if not all things, most things in-house. And there's a handful of, more than a handful of publicly traded home builders. They provide insight into this industry. They provide some very extensive and well-detailed and well-documented financial statements. And so, to sort of close the loop on financial statement review and understanding, we will go through the K1, I'm sorry, the 10K, the annual financial report of a home builder. And you'll answer some questions. So the questions aren't tricks. There's no rhyme or reason to them. It really is just walking through different parts of the annual report so that you look at different facets of them. I try to focus all of them in one way or another into situations or circumstances that impact the real estate industry. So, you know, you might have questions on payment and performance bonds and what they might be, you know, because they may be talked about there. There might be questions on commitments and contingencies, which we talked about today, but home builders tend to buy or historically have taken, say, the last at least 15, 20 years, have taken land down on option agreements that they've made with some SPVs, and that's a whole other sort of ethical issue with people that are friends and family of the, you know, major shareholders and things. But anyway, I've chosen a company out on the west coast of Florida called WCI Communities. I've used this company on...
Half my company is WCI. They went under hard.
They did, and I've used that company. I actually used their last 10K prior to the bankruptcy in a case. It was a very interesting situation at the time, because it was like, you could see it was going to die, it was just a matter of time, but it was everything, again, trying to situate where we were at the time, 2008, 2009, all the ills that were affecting the home building industry and real estate development as a whole, and it was all sort of, it all sort of came together in this particular company. It's now come back to life. It's in a smaller scale, but it embodies a lot of what home building activities are, and it's a nice little sort of easy to get your hands around company. I've used other bigger ones. I spent a lot of time trying to pick this one, and it just seemed like it was a nice mixture between a variety of topics, but something easy enough to get your hands on. The only thing that so, you know, you're going to be directed to, you know, the company. It'll tell you where you can get the 10K. Does everybody know where to get a 10K if they want to know where to get a 10K? So the easiest place is to go to the company's website, go to the investor relations section, and all the public filings will be there. You can also go to the SEC site, or you can go to Edgar, a site called Edgar, EDGAR. The easiest place is go to the company website, go to the investor relations page, and look at their filed reports. When you get to 10K, the only thing I want to go through with you in advance of that is basically the table of contents. And basically all 10K, so 10K is a form that's required by the Securities Act of, well, indirectly. So the Securities Act of 34 created the SEC, which enforces the Securities Act of 33, if I have my numbers right. And it creates, so the SKs are regulations that have the annual reporting that public companies are required to file is a 10K. So it's a financial statement that is very comprehensive in nature. So in addition to the sort of audit opinion, balance sheet, income statement, statement of cash flows, and footnotes that are filed, there's a whole bunch of other information that's filed. They're required to talk about their business. They're required to talk about risk factors, and they go on forever about risk factors. You're going to say, are these really risk factors? Well, maybe, maybe not, but when you read through them, so, my recommendation is that you go through a report and then answer the questions. Now, you can look at the question and then try to go back to the report, but then you're going to miss some of the learning. Okay, so glance through it. You're going to see this particular company lists something like 50 different risk factors that affect it. It definitely will be helpful and will jog your memory as to, well, what risks do we have in our businesses, and might they affect me and my personal business? Unresolved staff comments, hopefully there aren't any. So that's, you've got an issue with the SEC. I've never seen one, but typically when you've got an unresolved staff issue, you don't file your 10K. So I've never seen one. You need to talk about your properties. That's kind of interesting for a development business or a home building business, because that is a substance of their business, is the properties that they own. So there's extensive information here. For most operating businesses, properties are not a significant disclosure item, right? They might own a couple of warehouses or something like that. They talk about the market for their publicly traded instruments. You've got an issue where you've got to address certain summary financial data. So you take the financial statements and summarize them, which leads to section 7 in all of them is the MD&A section, the management discussion and analysis section. And so management is required to provide their insight into the results of operation. Okay, so they go through extensive, our business was impacted by this, the variations in our business were a result of this, etc. So it forces management, is forced to inform their stakeholders of what they're seeing. And in section 8, I'll stop at section 8 is their financial statements, okay, and the footnotes. So a whole bunch of other information that's required regarding executive compensation and things like that. Some of that is then covered in greater detail in a DEF 14A, a supplementary or proxy statement that's issued later on after the issuance of the financial statements. But I'll walk you from 1 through about 8 with different questions. And hopefully, while it may seem like you're answering questions, hopefully you're getting a flavor for what a public filing is, what a public filing in real estate is, what financial statements look like, what some of the things we talked about today, commitments, contingencies, risk factors, internal controls, balance sheets, what all that means. And more than that, hopefully you'll see what a home builder here in our state, in our general area, in our general region, what they do, how they perform, where they make money, how much money they make, right? And how their business is operated, right? So, in particular, one of the nuances or one of the differences between a home builder and a fee-based developer is that a home builder needs to have inventory of land, and they need to have a pipeline of land, whereas a developer tends to be much more of a merchant or opportunistic, guy who identifies an opportunity and then attacks it and develops, and rarely has the capital available or the sort of patient money to have, inventory sitting out there. Okay, so hopefully you find it interesting. Hopefully you learn from it, and that's what you're going to have. So with that said, we've got, I'll give you about 5 minute break before we have our quiz. And let me just glance through my quiz questions to make sure we've gone through them all.
We're allowed to use notes.
Of course, notes. Let's not have a quiz. They just put 100 on it.
Well,
Okay.
see if it's time.
I'm going to give you a little summary real quick. These are the general concepts. Leases, underlying FASB 13, sales 66, cost 67, interest 34. I'll leave that up for a couple of seconds, okay? We've talked about the 5 basic, components of a financial statement. I've said that multiple times. We've talked about the headings that all financial statements should have. Name, statement, the period that it covers. We've talked all kinds of, abbreviations that we've had, okay? I mean, all SPV, GAAP, MSRED, PP&E, we've gone through those ad nauseum. We talked about in the real estate realm, rather than rather than relying on net income, we typically talked about, one second there, we talked about NOI, we talked about cash flow as a proxy for net income. So in private business, we talked about NOI. In REITs, we talked about FFO, which was similar to NOI. Net income plus depreciation, plus or minus gains or losses on sales. We talked about a further or more refined measure of that being AFFO, which is FFO plus or minus plus CapEx, plus or minus adjustment related to straight line rents. Okay? Daryl, you had a question.
Earlier you said development cost was 34, there you had investments.
No. I said development costs are 67, but as it related to construction period interest, it was 34.
Oh.
So 34 was issued before 67, and I don't want to get into so FASB 34 does not need, right, FASB 34 needs to be used by everybody. Only development businesses need to use 67. So as it relates to construction period interest, whether you're a developer or not, you need to adhere to FASB 34. But 34 is construction period interest, which falls under overall development costs, which are covered in 67. Does that clarify it?
What was the formula for funds from operations again? NI plus...
You want me to repeat it? I just said it.
NI plus depreciation. It was the plus or minus that I was missing.
But so you add depreciation and plus or minus gains on sales of assets. We talked about non-monetary exchanges. I said I was going to cover that APB 29, but in tax realm that was 1031. We talked about a similar concept for involuntary conversions for condemnations, which is 1033, which gave you a tax-advantaged opportunity to reinvest. We talked about different legal structures that we could use, and the preferred, disregarded, or tax-advantaged entities that we like to structure real estate operations around. We talked about what real estate was. We talked about what leases were, right? Land and improvements thereon, and leases were rights that we were given to real estate, right? We talked about the basic underlying equation in accounting, which was assets equals liabilities plus owner's equity. And ultimately, that was just, the double-sided entry of accounting, which debits have to equal credits, right? Any questions? Okay, if you guys clear your desks of all electronics, electronics, paper, notes.
Still get that 5 minute break?
Okay, listen. You- Hey, so,
Get your break in 5 minutes.
so I said that, well, you guys, so the couple of observations that I'm gonna make, as I said, I need your help, and you guys have been great. I know it's hot in here, I don't know why.
5 o'clock, anything with that.
Yeah. Save your operational expenses.
Okay. We didn't pay our cam?
Typically our kick.
Okay, then you guys have been great. The only thing I ask, I still continue to have electronics on, and I'm telling you, I'm gonna stop the class, because I lose my focus. It's 7 hours standing up here, I lose my focus, you know, because I just lose my focus, so I need your help with that. And the other one is, I've never had this one before, and it was, I got way too much talking going on. If you have a question, ask. If you got a comment, you know, either wait for a break or just go outside. You know, you need a break, stand up. I have no problem with that. You know, some of you had to stand up, I have no problem with that. But the chatter, it forces me to talk louder. It's involuntary, right? And like I said, I'm already here with, you know, this. But it's just, it's rude to the people around you, you know, so please help me with that. If you got a doubt, you know, stop me. If it's just, you know, comments from the peanut gallery, if they're funny, you know, raise your hand and share them with everybody. If they're not, just leave them for a break, please. That's all I would ask. But other than that, you guys have been great, okay? So I look forward to our next class. And as I said, any questions you may have on the assignments or on anything that we covered in this class today, please just shoot me a note, and I promise that I will do my best to get you the answer that you're looking for. And with that, question number one. Question number one.
1 second.
Well, I thought you said you didn't want a break. Oh, you do want a break, okay.
Yeah, you should do everything.
Oh, you need paper, of course you need paper.
How many pages?
No, I'll just absorb your answers. Oh, I hear.
No.
Fred, I have a student who brought his textbook, but it was still covered in plastic. Does he get early preparation credit or not?
Yeah.
Sorry? I'm waiting for everybody to get to the paper.
Question 1.
Ready, Stu.
Question number one. Generally, FASB 34 covers what topic? Generally speaking, FASB 34 covers what topic? Obviously related to this industry. Generally speaking, I'll tell you a funny story. When I was doing my master's, I brought one of, because I brought one of my fellow classmates. A guy, he works at a bank, has nothing to do with real estate. He sat through my class, he took the test, the guy got 100. The guy got 100. Nobody else in the class did. And he wasn't in the program. So it's all, we've covered all this, like you should get 100 here, okay? Question number two, generally speaking, what topic does FASB 13 deal with? I wrote these down, Tyler, like I just wrote them right down. They were up for an hour. Generally speaking.
I'm confused, where is number 1?
Okay, I will go back afterwards to any questions that we don't have. Question number three. Generally speaking, what does FASB 67 deal with? Generally speaking. Last one, generally speaking. What does FASB 66 deal with, generally speaking? 66.
What were the numbers from 1 to 4? It was.
34, 13, 67, and 66. Okay, question number 5. Please detail three out of the 5 basic components of a financial statement. Detail 3 out of the 5 basic components of a financial statement. Question number 6. Oh wait.
Did you want us to detail 3 or list 3?
List.
Okay.
List. Question number 6. Question number 6. Please detail the proper heading for a typical income statement. Please detail the heading for a typical income statement.
Sorry, did you say income statement?
Income statement. Okay, question number 7. Please define the terms GAAP and NAREE. GAAP and NAREE.
Do you want the acronym or do you want just what they are?
Well, I guess the acronym is GAAP, so just write it out.
Wait, what was the second one?
NAREE.
Sorry. Thank you. I didn't hear that last one.
NAREE.
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 Can you spell that one? Yeah, how do you spell it?
You serious?
Yeah.
Please define the following 2 abbreviations: PP&E and SPV.
Ask what?
SPV.
What's the first one?
PP&E.
Can you spell that one?
Question number 9. Question number 9. In a REIT structure, in a REIT environment, what is the proxy for net income and how is it calculated?
What number is this?
Number 9. In a REIT environment, it's a proxy for net income and how is it calculated? Question number 10. Question number 10. Involuntary conversions are covered by what section of the Internal Revenue Code? Involuntary conversions are covered by what section of the Internal Revenue Code? Question number 11. We've only got 4 more to go. Question number 11. The problem is if I give you 5, each one's worth 20. Please name a typical legal structure, tax advantage legal structure, which a real estate development company can use. We went through 5 of them right now. Just name one of the 5 or 6 different tax advantage corporate vehicles that a real estate company can use. Question number 12. Please define CAM and tell me what it represents. CAM. C-A-M. CAM. C-A-M.
What was the second part of that question?
And tell me what it means.
You just want to set the word.
Doesn't it sort of
You
describe
could just,
itself?
you know, sorry?
Doesn't it describe itself?
I mean, if you think it does, then you know, I'll evaluate that when I grade it. If I'm asking for a little more than just it defining itself, then I would put a couple more blurbs, you know. Question number 13. What is a lease? Question number 14. For purposes of this class, what is real estate? For purposes of this class, the accounting class, what is real estate? Final question number 15. Which side of T accounts and debits go on? Right or left? Which side do the debits go on? Right or left? And any doubts, just let me know, and I'll repeat the question.